Hello, fellow risk takers, and welcome to my worst investment ever. Stories of loss to keep you winning. In our community, we know that to win in investing, you must take risk, but to win big, you've got to reduce it. To join our community, go to myworstinvestmentever.com and receive the following 5 free benefits. First, you get the risk reduction checklist I've created from the lessons I've learned from all of my guests. Second, you get my weekly email to help you increase your investment return. In fact, the last one I did, I reviewed a fund out there that owns 9,000 companies. Third, you get a 25% discount on all A Stotts Academy courses. Fourth, you get access to our Facebook community to get to know guests and fellow listeners. And finally, you get my curated lists of the top 10 episodes. Fellow risk takers, this is your worst podcast host, Andrew Stotts from A Stotts Academy. And I'm here with featured guest, Simon Bedard. Simon, are you ready to rock?
Absolutely.
Let's get into it. Well, Simon Bedard is the CEO of Exit Advisory Group, a boutique M&A firm that also provides a range of advisory services focused on exit strategies and how to maximize company value. Simon's experience spans over 20 years in the finance, investment, energy, and technology sectors. As an entrepreneur, Simon has started, bought, and exited his own companies. He has also worked for one of Australia's largest banks as an investment advisor to high net worth clients and private companies. Ladies and gentlemen, Simon's passion is helping business owners understand where they want to be, then building a business that can get them there. Simon, take a minute and fill in further tidbits about your life.
Yeah, thanks, Andrew. Look, I guess I, like many people, have been around business for a while now, and I guess probably where I find myself today is the basis of seeing so many things out there that just don't turn out. So many, I guess, injustices that I just find to be somewhat frustrating, and on the other end of the scale, just completely outrageous. I'm one of these people who believes that business owners and entrepreneurs are the ones who actually change the world. They're the ones who see issues in society and problems that need fixing and then actually do something about it. And they don't just talk about doing it. They're usually out there mobilizing their capital, their people, their time, all those valuable things for themselves to go and fix problems and, take a lot of risk doing that. And so, I guess where I find myself and what we do today is because we've seen so many business owners and entrepreneurs take those risks, trying to do good in the world, run that marathon, get to the last 100 meters, trip over, and then don't get the rewards they deserve. Being invited onto your podcast was really interesting because it very much sort of aligned with some of the issues we see out there, and obviously a desire to help people minimize that risk and get the kind of outcomes they want.
I really love that story, or the way of framing it, because entrepreneurs, first of all, entrepreneurs are freaking crazy because we know the odds are stacked against us. And anybody can tell you the statistics, 10% of businesses make it after 3 years, or whatever those statistics are. And I would say that most of those statistics actually aren't even that great, because one of the things that you could say is that, even if you survive 5 years, the question is, are you paying a serious dividend to yourself and other shareholders while also paying a serious salary and compensation to yourself and your management team? So even the survivors aren't really thriving. So maybe the odds are 1 in 100 that 5 years later you have a real cash machine. And yet every entrepreneur believes they're going to be that one. Otherwise, they would never put their time and money behind it. So it is absolutely the madness of the entrepreneur that actually does, as you say, bring the world forward, bring out those new ideas, because they really, truly are. So now I was thinking about the marathon and falling down just before the finish line. We've all seen those kind of videos on the GooTube. And basically, I was thinking about an entrepreneur. I'm thinking about you, and I'm imagining an entrepreneur army behind you, and you're leading that army to get across the damn finish line. Let's go, help support each other. So I really love that, what you're doing. So that's great. And I think for the listeners out there, if you feel like, you're worried that you're not going to make it across that finish line, Simon's a guy to talk to. And for the listeners out there that, want to get in touch with you, what's the best way to do that?
Look, probably the best way is to reach out to me on LinkedIn. And if they actually mention that they heard of me on this podcast, put a little message in a connection request. I'd be very happy to connect with people. So LinkedIn certainly, or of course go to exitadvisory.com.au and you can check out our website.
From now on, when I see you and hear from you, Simon, I'm going to imagine an army of entrepreneurs behind you, and you're leading the charge to the end of the finish line. So,
well, I appreciate that.
Yeah, that's my image. Now it's time to share your worst investment ever. And since no one goes into their worst investment thinking it will be, tell us a bit about the circumstance leading up to it, and tell us your story.
Yeah, great. Thanks, Andrew. So, I guess when I thought about what my worst investment ever was, I had to sort of take a step back and think about, all the different things that I've been involved in that have gone horribly wrong, right? And so I guess, for the interest of the story, I've gone for the thing that was probably the biggest financial impact. And it wasn't a type of investment where I've gone and put in, a chunk of money into something and then it's gone bad. I've had plenty of those, by the way, as well. But probably the worst investment in terms of outcomes was really an episode with our business. It was investing in a client. We are a boutique firm. We're not one of the big global accounting or consultancy firms where we have a team of 10 people. We are not a volume-based business. We take on clients who, we believe in their story, we believe in what they're doing, and we believe we can help. And so you have limited scope and resource to be able to take on clients, so we are quite selective around that. And it's not always size, it's more about the people and having belief in what they're doing. So look, we had a client, we took them on, we worked with them for almost 2 years. We worked with them, gave them a lot of advice on how to build their business, how to extract the most value when they did sell. And so, for those who have heard, obviously, boutique M&A, right? We're helping people buy and sell companies a lot. And we do a lot of advisory work on helping them how to grow value and get to the goals they have. So we had a client, we agreed to take them on. We did a lot of work. And clearly in M&A, big part of our remuneration is the success fees. It's getting a deal done and getting the outcomes they want and getting remunerated and hopefully remunerated well for that. And so, yeah, look, I guess we had these clients, we negotiated a contract, we had a standard fee that we put in there, which based on the valuation we did would have meant a solid 6 to early 7-figure sum for our company. Which frankly, given the amount of resource we were throwing at it, was reasonable. What was interesting though was the client came back and actually renegotiated the contract. They wanted to change our fee. They wanted a sliding scale. They said, we want to motivate you so that you push for higher valuations. So, we're over certain thresholds, we're going to give you a bigger chunk. And the funny thing was, I actually said to them, look, that's not necessary. We're actually motivated. If we didn't want to do the best possible work we could do for you, we wouldn't do the work. That's who we are and how we work. So, it was on one hand a little surprising. On the other hand, it was, look, I get the thinking, and look, hey, if there's some great upside, it works for everybody. So fabulous. So we agreed, and we actually agreed to their recommended percentages. And what it really meant was, I guess we were looking at their valuation and looking where they were going. And we thought, okay, well, look, if there's a 10 to 20% upswing in the valuation, or we can negotiate a better deal for them, then that's wonderful. And probably what they didn't either expect or foresee, certainly we didn't understand it from looking at what they'd already told us about their pipe, was that their business grew a lot more in the next 12 months than I think what they expected. And so by the time it came to getting the deal done, the valuation was probably 50% higher than what we actually thought it would be originally. And so, our fee went from, high sort of 6-figure, possibly low 7-figure to over $2 million. And I think there was not just reticence. I think, you know, they've had their own circles. I think by the time it comes for people to actually make payments on things, you know, there's buyer's remorse. There's people in their ears saying, I can't believe you're doing this. And regardless of the fact that, you know, you've done the work, you've gone the distance, you've spent the time. And so in the end, what happened was the client fundamentally fabricated and a whole bunch of things to get out of paying us. They slung a whole bunch of mud at us, which was just absolute drivel. And this was a week before closing. So, you know, you can imagine the sheer frustration after this amount of time. And you know what it is, Andrew, like the disappointing part of it all was not that the fee, I mean, it's disappointing if somebody tries to renegotiate your fee. The disappointing part wasn't that they came to us and said, guys, you know, we know a deal's a deal, but geez, you know, like nobody expected this. Like, you know, just from a sense of being reasonable, guys, would you be willing to sit down and take another look at this? Because this fee has blown out massively and none of us anticipated it. And we feel like it's a little bit unreasonable. Now, if they'd come to us and said that, you know, I'm a reasonable guy. I think most people are, and would have said, you know, you're right, this has blown out and I'm willing to make a concession here. But instead they went down the path of just blatantly making up lies and actually put all the money aside, Andrew, like all the money aside, like it wasn't that I'd put that money in, it was an opportunity cost, right? It was just that we didn't get paid for all the effort and time and all the things that we did. So it's not like financially it would break me, but it actually what hurt the most out of all of that was the personal slight. It was the slinging mud at you and trying to make it look like we've done something wrong, or, you know, which is pretty hard to excuse when you're a week away from signing the best deal of your life. So yeah, look, you know, so you know, you think about what $2 million can do for your planning and where you go with it and how it helps your business and how it helps your family, and it hurts.
Yeah.
But yeah, not quite as much as it hurts your ego and your personal sense of values and judgment and things like that. So
how would you describe the lessons that you learned from this?
Painful, bitter. Not going to lie, I still feel I still get a very bitter taste in my mouth when I think about it. But look, I'm working on that. Look, what are the lessons? I mean, you know, there were so many. You know, there's lessons in how you structure your contracts. There's lessons in you know, even thinking about whether a deal could blow out and end up being too good to be true. Thinking about where does this put a client in a position what if the unexpected happened, but very much on the upside? Does that actually have ramifications? So it really made me think about how we structure deals. It also really made me think about how I structure contracts going forward in terms of things I'm willing to accept or things I'm not willing to accept. You know, there were certainly elements of that contract that, you know, they were able to exploit, and they very much did exploit because the contract wasn't as tight as it could be in certain areas, or maybe certain definitions weren't defined as well as they should be. So I think there's contract issues. I think there are very much a lot of people issues in terms of understanding how people think and how people engage, and doing that basic scenario analysis, right? Like high-end outcomes, poor-end outcomes, somewhere in the middle. How will clients likely react to certain things? And let's make sure we don't put people in positions too where they might feel like they're overpaying. Although one would argue that they've done those things and there's sums in their head. I mean, they're pretty smart guys. So yeah, so look, lots and lots of lessons. Yeah, indeed.
Maybe I'll summarize a couple of things that I take away. You remind me of a story of one of my good friends in Thailand. He came to Thailand and he went to a broker in Thailand back in probably 1990. And he said, you know, I can bring you institutional clients, you know, fund managers from around the world to execute through you. Let's set up an institutional client division and I'll run it. I'll hire the staff. And I could probably double your revenue just by getting 5 or 10 big institutional clients. Well, they loved it. And in particular, everybody loved it because the company was planning on doing an IPO. So they said, and he was smart enough to say, I want, you know, a share of that as part of the compensation because we're building a really well-rounded business. So he worked his butt off, did a great job, brought in a lot of money, And when the time came to do the IPO, they didn't want to deliver him the shares.
Yes.
And he said, they said something, they said, if we, because it turned out that, you know, the share price was super high when it went into the market. The market was booming. And they said, if we knew the share price would be this high, we wouldn't have given you this deal. And he said, and that's the whole reason why I signed the deal, because I knew the share price could get high.
Yeah, I had more faith in it than you did.
Exactly. And the whole point is that contracts, and this is, I think, a big lesson I took away from that, and I take away from your story, is that contracts only matter at the point of conflict.
Yeah.
And it is at that point of conflict that you've got to, you know, make sure you're protected for that. And the way he did it in Thailand is he went to his highest connections that he had, explained the story, and he used those political and business and other connections to put pressure on these guys to honor the agreement. And eventually they did. He got paid out. He took that and started Vietnam's first investment bank and made a ton of money out of it.
Yeah, so that's great. And Andrew, you know, if I can interrupt you there for a second, I mean, I think the flip side story to that as well is, for anybody listening to this, the answer is not to go out and make your contract so super tight and aggressive that you can never lose, because that's not commercial. You'll actually never get a deal signed either, right? So it's actually learning how to navigate this very, very different course, because it's a different course with every single buyer, right? Different personalities, different deal, different underpinnings to the agreement. So you've really got to learn where the line is and learn where, you know, where are the real risks, you know, what are the things that are worth giving up that won't necessarily cost you, but maybe are important to the counterparty. Because if you can't find a way to make it commercial, you'll never actually do a deal.
Yeah. And, you know, there's another story that comes to mind, and that is I work for a particular investment bank, and they basically said, we don't think we're going to need your position anymore. And I said, well, I'm going to go across the street and I'm going to set up my own business. And but there's a non-compete clause that says I can't do what I was doing at your business, but that's kind of the core of what I do. So and then also I needed to hire my right-hand man, and there was a non-solicitation contract that said, in the contract clause, it said you can't hire anybody for 1 year. But I walked across the street and I started my business with the exact same technology and same idea, and with that guy, and I did it legally. How did I do it? I talked to the CEO of the company and I said, if you don't need me anymore, I know this is a contract, but I'm asking you, would you allow me to be out of these clauses, because you're not going to use this. You've already said it. And we came to an agreement, and I left the contract, and then I started it. And the lesson is talk. Contract is just a thing, but it doesn't have to be everything. And like you said, you know, things change, you know, and we can always talk, and just talking can help resolve issues, and then contracts can be modified.
Yeah, absolutely. I mean, when people dig their heels in on issues, it's funny, they don't often come out and just openly tell you, though, this is the actual real issue. I mean, often they're using a clause in a contract to try to protect them against something that they don't really want to voice. So if you can get to the heart of what's actually really concerning people and where they see risks, often, you know, you could be completely at odds about what you were thinking about, right? So yeah, as you say, talking through it often is the only thing that'll solve the problem.
Yep. So based upon what you learned from this story and what you continue to learn, what one action would you recommend our listeners take to avoid suffering the same fate?
Yeah, look, I think, you know, we probably covered it, really, is to really look at each deal and look at the people, look at the different sort of elements of any sort of investment you're going into, whether it's an investment directly of money or an investment of time, opportunity costs, all those sort of things. Like, make sure you spend the time to understand the variables, you know, because ultimately, if you don't understand all the information, then you're making decisions on flawed information. And whether that's about the people themselves or the contract, you know, you've really just got to assess it all and understand where the risk really sits. Great
advice. Last question. What's your number one goal for the next 12 months?
Yeah, look, our number one goal, other than, you know, some of the, I guess, more sort of financial metric goals of the business is just to continue growing our team. We want to have a bigger impact on the world. We have a really strong why as to why we're in business. And, we're a small business. We've got about 10 people at the moment, but we can't cover the sort of areas and the number of people that we want to help. And, I'm still trying to work out how to clone myself. So if you work out how to do that, please let me know. But, but yeah, looking for good, solid advisors and people who can come and join the team and help us have the kind of impact we want to have.
Great. Well, listeners, there you have it. Another story of loss to keep you winning. My number one goal for the next 12 months is to help you, my listener, reduce risk and increase return in your life. To achieve this, I have created our community at myworstinvestmentever.com, and I would love to see you there. As we conclude, Simon, I want to thank you again for coming on the show. And on behalf of A Stotts Academy, I hereby award you alumni status for turning your worst investment ever into your best teaching moment. Do you have any parting words for the audience?
Look, be kind to yourselves and to the world. We need more kindness. Amen.
And that's a wrap on another great story to help us create, grow, and protect our wealth. Fellow risk takers, this is your worst podcast host, Andrew Stott, saying, I'll see you on the upside.